Hey everybody, welcome to your weekend review for the week of January 9th, 2023. And oh, what a week it was. Monday started off with MBS being up 19 basis points early. The 10-year was pretty flat. Stocks extended global gains as risk assets driven by China's reopening trade and expectations of slower rate hikes. The dollar weekend and oil rallied. The U.S. December inflation report due Thursday will be front and center in the minds of traders after last week's job data failed to show a clear picture with unemployment at its lowest level in decades and wage gains were weakening, though still positive. December ISM has now dropped into contraction territory, dropping to 49.6 from 56.5. Other than COVID, this is the first time it's been below 50 since December of 2009. New orders were in at 45.2. One great line from the report said orders from customers are softening and some orders are being canceled. We have lost employees due to normal attrition and having troubles backfilling positions. The supply chain is catching up. So that's a good summary of what's kind of going on out there. I thought that was pretty concise. Highlights for the week will be Powell's speech on Tuesday, 2 Treasury auctions, CPI on Thursday, and sentiment on Friday. At the end of the day, we ended up being up 19 basis points. We took a long road to nowhere all day today. This puts us into that ever-consolidating range, very narrow range, with a ceiling of 101.671, a floor of 101.01. So we're right in the middle of there, and it looks like it touched both of those today. We have a lot of support here underneath with a Fibonacci line and several moving averages. Another positive for inflation is ocean shipping rates are down 80% from their peak in September. It may not have a massive effect on prices for consumers, but everything helps. Also got notification that the National Association of Mortgage Brokers have met with the FHFA to discuss targeted increases in upfront fees for most cash-out refinances. So it sounds like the FHFA, which for those that are paying attention is Fannie Mae and Freddie Mac, are talking about increasing the costs of doing cash-out refinances. So keep an eye out for that and support your local NAMB or Mortgage Bankers Association because they are fighting for you. And another story that makes to support my theory that this is going to be the weirdest, most confusing recession ever. Rolls-Royce sees sales records in 2022. No slowdown in spending by the wealthy. We previously talked about how Lamborghini has already sold out its entire 2023 production run, and Rolls-Royces are selling strong out there. So yeah, it's a recession. Maybe. And on Tuesday, MBS were down almost a quarter point really early, mostly from the European hours as the European Central Bank made comments about the economy needing to slow down. This accelerated on the U.S. Open, mostly gains taking from the last 2 days of gains plus strategy prior to Powell's speech and the CPI coming on Thursday. NFIB index dropped in December to 89.8, below all of the estimates. The National Federation of Independent Businesses overall business optimism index dropped to the second lowest level in nearly a decade. Inflation continues to be the most important issue. Despite the overall gloom, there were some positive points in the survey. Inventories are back in balance, which means supply chain issues in the post-pandemic period are largely in their rearview mirror. December job growth was 223,000, the weakest reading since December of 2020, and wage growth pressure is clearly waiting, but we have a long way to go. The unemployment rate is at a 50-year low. Job growth is roughly double the sustainable pace. Labor force participation rate is essentially flat, job quits increased, and the underemployment rate set a new low. Rates go up by 25 basis points, maybe 50 basis points on February 1st. Minneapolis, Fed President Neil Kashkari wrote an article on inflation which discusses what the Fed missed in 2021 and lays out what might be his plan going forward. His point is that when prices rise, both supply and demand should adjust. Rising prices should decrease demand and increase supply. The problem is that supply hasn't increased. He likens it to surge pricing on ride-sharing apps. When it rains, more people would rather ride than walk. Prices rise. However, what happens when every available driver is already working? Supply doesn't increase, and that is where we are now. In economic terms, the supply curve is vertical. Increased demand just increases price. At the end of the day, we are down 20 basis points on the MBS, which put us right around that 25-day moving average. So we're pretty much right on that. And looking at all of these technicals converging, like I said, it is a very tight range. So hopefully that will keep things stable for a while so we can have a little bit of normality. A massive mortgage credit report price hike is expected in 2023, according to a letter from the National Consumer Reporting Agency, NCRA. So Rocket and UWM are jockeying with initiatives to help brokers shield from these increases. Fair Isaac Company has grouped mortgage lenders into 3 tiers, according to a memo to lenders in November, with a wholesale price increase of less than 10% for the top tier, which is about 46 of them, about 200% for approximately 6 lenders in the middle tier. That's 6 and 6? That's just a weird number. And more than 400% increase for all other mortgage lenders. So in response, Rocket Road TPO, the wholesale arm of Rocket Mortgage, is providing credit reports at no cost to brokers when closing loans through the Detroit lender. Rocket's competitor UWM recently announced a flat rate of $37.35 that they're going to sell mortgage or credit reports to brokers for, although there is some controversy that they may not be able to pull that off because Fair Isaac might say, hey, Credco, we did not give you permission to be a reseller of this stuff, so take it back. So that one can bounce. We also got a post from our sponsor at WellThatMakesSense.com. Hopefully you got your goals set for the year, because now we're going to talk about how to make it happen. And the best book for coming up with a format for making things happen and getting things done is Traction by Gino Wickman. So we have a 9-part series coming that's going to show you how to set up a format to get what you want done in 2023 and get it all done. The other thing that's probably coming is I've gotten messages in the last 10 minutes and I'm waiting for a confirmation text. It hasn't come yet, but word on the street is that Wells Fargo might be exiting correspondent lending business. This is a pretty big thing, although they haven't been a big player lately. They announced earlier this year they're going to scale back mortgage operations. However, after the crash and subsequent years thereafter, they were a big part of helping stabilize things for independent mortgage bankers, and they've been a giant purchaser of loans over the years. So there will be some ripples from that if that is the case. Oh man, so much news on Wednesday. UMBS 5.5s were up 17 basis points on the open, mostly trades in prediction of the CPI coming tomorrow. Federal Reserve Chair Jerome Powell, in remarks Tuesday, refrained from commenting on the outlook for monetary policy before the December Consumer Price Index figures. Signs of cooling could support a move towards slower rate increases, even as some officials say it's too early to declare victory in the fight over inflation. Market expects inflation to drop from 7.1% to 6.5%, and core is expected to drop from 6 to 5.7%. These numbers are still really high. Powell also acknowledged that the Fed is getting pressure to act on climate, in quotes. This means he's getting pressure from activists to use the Fed's supervisory authority to discourage investment in fossil fuels. Man, can something not be political nowadays? Ugh. Airline stocks recovered from declines in pre-market trading after the failure of a key pilot notification system operated by the FAA disrupted morning air travel. Big news yesterday from Wells Fargo, a behemoth in the mortgage industry, one time having over $1 trillion worth of mortgages and servicing. It will stop all correspondent lending relationships and look to reduce the massive servicing portfolio. This change in focus has been telegraphed, and as Bloomberg puts it delicately, their mortgage business has entangled Wells Fargo in regulatory probes and lawsuits, meaning the CFPB has made them their whipping boy because they always roll over and pay, so they've had to pay tons of money. However, we all have to nod our cap towards Wells Fargo a little bit because them buying tons and tons of mortgages in 2009, 10, 11, and 12 kind of kept a lot of us going. According to CoreLogic, October rents were up 8.8% year over year, down from 10.2% in September and a peak of 13.9% in April. Zillow's index has marked November rents up 8.4% year over year from 9.6% in October and a peak of 17.1% in February. Lastly, Apartment List has December rents up 3.9% year over year, down from 4.5% and a peak of 17.1%. Catch up, Apartment List. Jeez, what's going on? Rents will soon be reducing inflation. according to Curinos. These numbers suck. December 22 funded mortgage volume decreased 67% year over year and 3% month over month. In the retail channel, funded volume was down 71% year over year. The average 30-year conforming retail rates dipped slightly from November, but are 319 basis points higher than the same month last year. Wow, that's a big increase. In other news, demand is dropping in a big way for super expensive homes. Bloomberg had a piece out earlier detailing the $10 million plus market. The number of signed contracts dropped much more than expected in the second half of 2022. The article notes that sales figures are strong given the elevated prices, but contract activity is already dropping off. It is also noticed that super prime is usually one of the last tiers to collapse, but the first to recover, as well as big wallet buyers will see opportunity in a soft market. Our focus this week has been on the notion of consolidation after last week's strong gains and ahead of this week's CPI. All important CPI comes out at 8:30 a.m. Eastern Time tomorrow. Friendly comments from Fed Collins favors a 25 basis point hike, helped modestly in the afternoon, as did well-received 10-year auction, but the potential movement following the CPI data is an entirely different league. It's been the most important monthly economic report for almost a full year now. At the end of the day, we're up 31 basis points, ending up at 101.39, which puts us right underneath that flat red line at 101.671, and then we have a major convergence of support underneath. So it provides some safety should the CPI number come in different than what people are expecting. Also got some news in the industry where a judge grants UWM partial win in the ultimatum lawsuit. So this is basically where American Money Line's counter lawsuit to UWM suing them over working with both Quicken and UWM. Apparently at least one part of that and a key part of that the judge kicked out. So a partial win for UWM. And Thursday the 12th was the day we've all been waiting for. MBS were up 8 basis points early this morning. It actually improved 10 basis points while I was writing my morning post. The 10-year was down 7 basis points early. Bonds were lower in the overnight session. Traders were clearly expecting a whisper number, as it's called, that was lower than the median forecast. Simply by coming in as expected, CPI managed to disappoint the market somehow. This is also ups the odds of a bounce back after the initial leg of selling. Monthly headline CPI came in at minus 0.1 on an expectation of being flat. It was 0.1 previously. Core CPI came in at 0.3 on a 0.3 forecast. So it was 0.3 previously. The news this morning was the CPI data released. It first appeared that someone had early data or something with the market rallying ahead of the release, but then the data came in right on the screws. Pretty much every reading matched Bloomberg survey estimate. There has been some healthy chatter in the morning in Chris Maloney's anonymous Bloomberg chat following the release. The market is pretty messed up and there's a lot of uncertainty about how the Fed will handle the rate raise going forward. If you take the last two readings of CPI and extrapolate it out for the next 12 months, the run rate would come in at 1.6% on the headline and the core would be 3%, though that would still be increasing prices along the way and establishing very high levels without deflation, which is really bad. They would just permanently stay high. Energy fell 4.5% month over month. Gas fell 9% and is down 15% year over year. Food climbed 0.3 month over month, is up 10.4% year over year. Yesterday's 10-year Treasury auction was pretty good. Today's bond auction 30-year came in at 3.585 versus a 3.610 forecast. Bid to cover was 2.45 versus a 2.36 average. Bonds were already rallying in the past 3 hours before the auction, but the auction results were kicking things into especially high gear. You won't see too many days with a 10 basis points plus rally in response to an economic report coming in right in line with expectations. That's pretty much what we had today. Wall Street looked past its initial disappointment with just an in-line consumer estimate to focus on the idea that an inflation peak is possibly in the rear view. That perception is visible in the swap market, which is showing less than 50 basis points of tightening priced into the next two Fed gatherings. A small chance of no move in March. None of that means, of course, the Fed will follow this and do what the markets think. At the end of the day, we were up 31 basis points, ending up at 101.70, and the 10-year Treasury came in at 3.444, being down 11 basis points. That reading of 101.7 puts us right up there, just above that Fibonacci 38% retracement line at 101.67, which is this brand new range. We have a lot of support underneath, so we'll see if it continues into that range tomorrow or if it flattens out and people will do some selling because they want to make the money they made today. And we also got a second post from our sponsor at WellThatMakesSense.com. This is from the book Traction. So hopefully you've set your goals for this year. And if you want to come up with a plan to make it happen, not just have it be something written on a board on a wall, and actually have plans to get it done, Traction is your operating system. So check that out on WellThatMakesSense.com. Bonds began the overnight session just slightly weaker and then held perfectly flat with the Asia session. In the domestic session, UMBS were down 14 basis points on the open as the market continues to digest and debate the future in light of the light CPI yesterday. With investors and the Fed in a face-off over the future of rate decisions, they're going back and forth. Volatility will remain elevated until such time as one of them blinks. This uncertainty should keep the bank's mortgage demand on the side through probably the beginning of summer. December import prices rose 0.4% month over month after falling 0.7% the previous month, according to BLS. Estimates of 0.9 negative were quite a bit of a beat. Reprice risk on the day was low, should be a pretty quiet day, and it pretty much was. We aren't likely to see rates drop much further unless we get a dovish message from the Fed at the end of the month. And it's not looking like that's coming. Fed members are still towing the line Fed members are still towing the company line that the Fed rate needs to be above 5% and not come down in 2023. Consumer sentiment improved in January, according to the University of Michigan. Inflationary expectations fell from 4.4 to 4, which is good news for those who want the Fed to take its foot off of the brake. Consumer sentiment is still awful overall, stuck at the levels seen during the Great Recession. Apartment list rental rates rose 5% year over year, according to data from Redfin. I guess it wasn't apartment list, it was Redfin. They were down 1.4% month over month and off 3.6% from the peak set in August. Some of this is seasonality. However, the massive growth we saw in 2021 is over, and rents will generally lag home prices by 21 months or so. The inversion between the 10-year and the 3-year Treasury is almost 120 basis points, strong correlation to a recession. At the end of the day, we were down 20 basis points, ending the day at 101.47, which puts us right underneath that flat Fibonacci 38% retracement at 101.671 with a very tight range and lots of floors. So we have 1, 2, 3, 4 floors, a convergence of floors. It's nice to be wanted, and the agency mortgage-backed securities spent QE4 era having a dance card constantly filled by not only a voracious central bank, but actually U.S. banks in general too. However, the Federal Reserve has stepped away and is allowing $11 billion or so each month to run off its balance sheet, while the largest domestic banks, which increased their agency mortgage holdings by 36.1% from March of 2020 until 2021 year end, have seen their holdings since drop 7.2%. Still, large banks' aggregate holdings come to $2.1 trillion, which is nothing to sneeze at. So the question becomes, just how robust might bank demand be in 2023 over the near term? At least the answer is not very likely. So they might be starting to sell some of that off, especially when you hear stuff like Wells Fargo, which reported fourth quarter earnings were half that earned the same quarter of last year. Elsewhere was better bank news. JP Morgan Chase and Bank of America both beat analyst estimates. Next week, we are closed on Monday for MLK Day. Wednesday, we will get core producer prices as well as a 20-year bond auction. And then on Thursday, we get a 10-year note auction with jobless claims. So it should be a fairly quiet week next week. If you have a long weekend, check out some of our sponsors, especially WellThatMakesSense.com. There's a special post stream going on over there from the book Traction. So if you have goals for this year, Traction is your plan and your operating system for getting that done. Have a great weekend. Take care.